Good morning, everyone. Good morning from wherever you are. Thank you so much for joining us for our second Nuggets of Life Youth Connect virtual forum of the year. We had our first forum in February, and if you're here and you were in the first forum, I just want to thank you again for just making time to be here. So, thank you so much for joining us this morning. We are looking forward to having a very insightful session. And I'd like you guys to just check in, just let me know where are you listening to us from, where you joining us from, and how you're feeling about the session. Any expectation you have from this session, you can drop that in the chat. But thank you so much for joining us. And I think at this point, I would like to bring in our host, Rosemary, just to give us a brief overview of Nuggets of Life for those of you who might not know what Nuggets of Life is about. So welcome, Rosemary.
Thank you, Holiday. I'm going to put my video on just so I can connect with everyone. Good morning, and happy May. It's a new month, and we are excited and grateful to God for the new month, for the gift of life. We are still here, we are still thriving, and above all, we are still trusting that more is coming. And so I think just taking a moment to acknowledge that we are here, not because we are too good, not because of our own capabilities, but really by the grace of God, who has given us yet a new month for us to continue to be leaders, for us to continue to thrive, for us to continue to journey towards our inheritance, whether that be the kind of job you dream of, whether that be education, whether that be more faith, whatever it is that you're trusting God for. But also so that we can continue to make progress towards each one of our destinies. And so this morning, we are here once again to continue to draw from people who are further along in their careers, in their journeys. We want to draw on from expertise that God has downloaded in our guest speaker today, so that then she can download that expertise, that knowledge, that wisdom unto us. And so today we do know that the topic is really around financial planning, but also how we can be more disciplined, how consistency can help us, not just in financing, but also in our other dimensions of life. So this is Nuggets of Life, and thank you so much for joining us. Some of you have journeyed with us, some of you are new, but I'll just take a quick moment to say why Nuggets of Life, and therefore why this session this morning. So Nuggets of Life journeys with young people who are either transitioning out of college, out of university, or young people who are new in their job markets, people who are new in their careers, basically that transition from university, from college into the job market. And we do this because we believe that our mandate is to fulfill three things, or to actually solve three problems. One problem is just being conscious that our education system, I see here on the call, we have people maybe from outside of Kenya, but across Africa, pretty much, our education system is structured to get you to pass exams. And I know right now, there are many education reforms that are looking at how we can get core competencies. We know we have the CBC in Kenya, we have the curriculum-based competencies, we have the curriculum-based education. And so we are moving in the right direction. But by and large, we are very focused on how do we make sure we pass the exams? How do we make sure we go to the university? How do we make sure we go to the college or the technical college of our desire? And so we grill more towards the education, the passing of exams. and less towards the character formation, less towards instilling values, less towards grounding ourselves in really just ourselves in terms of our identity and all that. So that's mandate number one, just recognizing that nuggets of life can come in and bring the other side of knowledge, of education that is not necessarily in school. The second mandate is a recognition that as you transition from college, from university into the job market, there aren't many places, or you find that you have young people who actually don't have access to mentorship, young people who don't have mentorship to say, how do you ensure that you keep the job that you got? How do you become good at the job that you got? How do you become a good steward of the job that has been granted unto you? How do you thrive there? How do you succeed? How do you not only keep the job, but actually you continue to package yourself into someone whose value people will come for? People will come looking for that value. So it's how do you succeed when you do that transition? So that's the second job mandate, that we want to bring that mentorship to you. We want to mentor. We want to journey with you along that angle as you transition. And the third mandate is just a recognition that right now the rates of unemployment among young people are high. And sometimes you might wonder, why am I even in school? Why even go through university? Why go through the technical college? Should I even bother? Because you are surrounded, or we are surrounded by so many young people who are graduating and not accessing job. But Nuggets of Life is really a platform that is conscious of that challenge and says, don't give up. Even though we know we cannot project, we are a children of hope and resilience. We are a platform that radiates resilience, that journeys with you around resilience, around just thinking about the mental vulnerabilities that exist because of the stressors. You are stressed about the job. You are stressed about, are you graduating, and then what? And so that is the third mandate, to say there are many mental vulnerabilities, but we journey with you around resilience. We journey with you around continuing to position yourself for the job market, continuing to navigate the stresses, the challenges that you experience. So those are our three mandates. And we are so honored to journey with an amazing group of mentors. So Nuggets of Life is a platform where people who are passionate about mentoring others converge. And we work together as mentors, each person bringing their expertise, their genius, their experiences to journey with young people. And so in terms of the program, there's one-on-one mentorship, there's group mentorship. There are sessions like this where it's open to anyone in the public who is looking for this kind of expertise and experience. And therefore today, we have an amazing session ahead of us. And I'm so excited about our guest speaker today. Our guest speaker today is not only someone I respect and value a lot. She is a great friend of mine, and we have journeyed together since high school. So these are high school buddies. And I'm honored to just know that God places people in our path who work with us towards our destiny, who work towards making us better. And so that is who Felistas is to me. And professionally, Felistas is a seasoned bank executive. She has over 20 years experience in various markets, treasury, finance, and accounting roles in Kenya. She is a CPA, CPA-K, so CPA Felistas, you're welcome. She currently serves as a vice president and head of local markets treasury at Citibank Kenya. And she's in charge of balance sheet and liquidity management for Citibank Kenya. So prior to this current role, Felistas was the Deputy Chief Finance Officer, that is CFO, for Citibank Kenya, and she was in charge of management, tax, statutory, and regulatory reporting. She holds a first-class honors, Bachelor's of Arts degree in economics from the University of Nairobi. Well done, Felistas. First-class honors is not, it's not a mean task. It's not a mean task. And she has previously, she's a mentor in her own spaces. She has previously mentored for the Global Give Back Circle, which is was supported by the Clinton Foundation for mentoring Kenyan girls in high school. Felistas is a mother with 2 young men whom she loves spending time with wherever she is away from work. She spends time with her family and friends, loves to sing, watch drama series, and read motivational books. So we are so honored, Felistas, that you could take your time out of your busy schedule to come and share with us nuggets of knowledge, of wisdom on the topic that we are discussing today, which is financial planning, and looking at also the concept of what is it called? Consistency and diligence and discipline. So let me hand it over to you, Felistas. In terms of the format for this conversation, Felistas will share with us what she has first, and then we will open it up to open conversation. So keep noting the questions you might have so that when we come to the Q&A and discussion, we are engaging effectively. So feel free to begin to drop your questions or comments on chat. Over to you, Felistas, and thank you.
Thank you, Rosemary. Thank you for the introduction, quite heavy, and I'm really honored to be here. Thank you for the opportunity and for thinking that I could add value into the Nuggets of Life platform, and for allowing me to be here to share just a bit on what I would consider life lessons around financial management, because, you know, we in our time grew up when finances were a delicate matter to speak about, and we didn't quite think about them, you know, or we didn't have mentors or even our parents discussing finances. It has been a sensitive matter. And as I've gone through the journey, I've thought that, you know, a couple of things perhaps would have been done differently if this conversation was had much earlier, in addition to, you know, taking personal steps into growing the knowledge. But we need to start having these conversations early enough. And I hope that, you know, a bit of what we will share today will be value adding. There's a lot to say about financial management, but, you know, just trying to see how best we can capture a bit of the bird's eye view and try to capture much more that we can take away from this lesson and be able to utilize it in our personal lives. So as I was thinking about what best to share, I framed my presentation in a few pillars, which I want to call pillars of financial success. And I thought about it like, you know, when you're building a house, you don't just build a house without pillars, without the right support system. Pillars really do support the house. And for this session, I want to look at some few pillars which I thought about in terms of financial success or financial management, personal financial management. And one of them on top of that list, I listed you and I having knowledge of our current financial position, which is what we call the net worth statement. And how I have handled this is I have listed these 6 pillars, and then we will look at them in detail. So for this first slide, I just want to highlight them. Then we go into each of these pillars individually and perhaps discuss. And from there, maybe we can get a few more insights, and any questions arising from each of the slides can then be discussed later. So we have you having the knowledge of your current financial position. And then once you have that position, because you can't start from where you don't know, then you make smart personal financial goals early enough, as the young people like saying, mapema ndio best. So if we can do this early enough, as I highlighted there on earlier, it will be best to do this so that we can then move on. Once we have smart financial goals, then we are able to effectively manage our income and be good stewards of whatever money that we have, whether we consider it much or little, but we do know that we never really consider money to be enough. So whatever little money that we have been given, we plan to be good stewards by effectively managing it right. Then once we have done that, we have goal-oriented investing, because it's not just about managing the finances. We have to think about it in terms of growth. How can we then do goal-oriented investing? We consider compounding growth. We have to consider the risks and returns, the liquidity, diversification, and cost averaging. And we'll look into this as we go into the slide that relates to that. Then once you have done this, you have to also think about managing the risk that are linked to these investments or whatever decisions that you're making financially. And you think about having insurance, having wills, having trust, matters that perhaps we never think about or we never discuss. We have to think about managing the risk, because we can take all the steps that we need to take, but we don't manage the risk, then the pot crumbles. Then, of course, we have to constantly keep, once we have implemented, we have to keep reviewing, periodic review of these decisions that we have made, periodic review of our investments, and especially when you have major life-changing events, we have to keep reviewing. We'll get into that, but just as a highlight, those are the 6 pillars that I would want us to have a look at. Now, if we can go into the first pillar, which is looking at the net worth statement. And what is the net worth statement? It is basically a snapshot of our financial position. Where am I? What do I own versus what do I owe? What are my assets, as we call them in finance, versus my liabilities? And when we look at this, then we are able to see our position. Do we owe or do we own? Right? So we are looking at, I've put a snapshot there of what would constitute maybe a net worth statement. Cash in the bank, cash in hand, money market funds, investments. And then on the other side, we could have loans. We could have, we owe people, we need to pay for something. We need to look at these things. And when we then take our assets and minus our liabilities, what the difference is, that is our net worth. The ideal situation is that our net worth should be a positive value. We cannot be, and we do find ourselves in situations at times where our net worth is a negative position, which is not ideally what it should be. So what we should be working towards is ensuring that we are growing that positive value, which is the difference between our assets, what we own, and minus what we owe, right? So when we grow that value, that difference, then we are growing ourselves in terms of our financial position. And then we know where we are moving from, even as we move to the next pillar of setting goals, because we cannot set goals of what we do not know. We have now analyzed our position. We know this is our net worth, it is X. We know if we need to be working towards increasing our assets or reducing our liabilities, then we can set the goals. And what kind of goals are we talking about? They have to be smart. And I know we have constantly referred to SMART goals in various facets of our lives, where we talk about specific, measurable, attainable, realistic, and time-bound. But here I want to look at it differently in terms of these goals, yes, have to be specific. We have to say we need to save, for example, 50,000. And when we say we need to save 50,000 is within this timeline for this purpose. And looking at where we have come from, our net worth statement, is 50,000 savings something that we can be able to do in our current position, right? So as specific as possible so that it guides you. Mutually agreed upon here in this case, we're talking about where we have parties, say, for example, in a family situation. We cannot go about where one party in the family is setting a goal that they have not agreed with their party. For it to be achievable, let's come together as a family and agree. this is what we are going to do. For example, we are going to be buying a home in the next 5 years worth this much at this location. We have agreed this goal. So therefore, as we employ the finances or deploy the finances towards that, we have agreed and we are not going to have setbacks. That's what the M here stands for. Is it attainable? Again, when we talk about buying a home worth, for example, 5 million, is it something that we can be able to do considering our net worth statement that we looked at first? All right. Then for it to be for us to commit ourselves, let's record it down. Once we record a goal, the probability of us meeting that goal grows by a big percentage. Let's record that goal and hold ourselves accountable. Just the same way we record other goals, even in the workplace, we put down our goals at the beginning of the year and we are tracked against those goals. Let's record these financial goals. We will buy a home in 5 years worth this much at this and this location. And we have agreed between you and I that we will do this or as a family. And therefore we record it and we track it within that period for which we have said we would achieve that goal. Then of course, because we acknowledge that we have many, many things that we would want to do with these finances. And we find that our finances are not, where they should be most times. We have to make trade-offs. We have to say, we will take this and leave this. We will do this investment, we will not do this one. Or we will buy time into getting to the other investment because we cannot be able to achieve everything at the same goal. So you take priority. Let's start with this. It's a higher priority. Let's drop this. By the next year, for example, maybe we will get to priority 2. So that's the smart financial goals. When we do this, then you're guided and you're able to effectively manage income. And how are you able to do this? If we move to the next slide. We are able to manage our income, as I alluded to earlier, by effectively knowing our position and tracking what we have against what we will perhaps be required to pay off. And the financial term for this is budgeting, where we are able to track our revenues, we are able to track our expenses, and this tracking helps identify any loopholes that we would have in the course of, our spending habits. And we do know we all have this, we can go about spending money without tracking it, and then we end up living beyond our means, and we are avoiding this. So let's do a budget. And by doing a budget, we are saying this is my revenue, these are my expenses. How much can I afford for each expense line if this is my revenue? Then, of course, along the way, we will be required to finance certain expenditure that perhaps we cannot finance from our revenue. We take loans. But how do we navigate these loans? How do we determine what is a good loan? What am I taking that loan for? Am I taking the loan to go and buy, clothes or for consumption purposes? Loans for consumption purposes are basically classified in financial terms as bad loans. And why are they classified as bad loans? Because you don't get any return out of it. Good loans should ideally be for investment purposes. You take a loan, you take that money, for example, and invest it in a fund that perhaps will pay you interest in the long run. You take a loan and invest it in a home that you will live in the long run. That's a good loan. We are not saying we avoid loans, but let's see how we navigate loans so that we only concentrate on the good loans and avoid bad loans. And lately we have many platforms where we get quick loans. We go into mobile money apps, we get loans. Very expensive loans if we were to sit down and look at the interest rate that we are paying. That interest is a cost. And when we do ask ourselves the question of, do I really need to pay this interest? Then perhaps we will get to a point where we say, I don't need to take this loan. Let's keep asking ourselves those questions when we need to borrow money. What is the cost of this borrowing? Can I really afford it? If I'm taking a mobile money loan and I'm being told that I will pay a certain percentage per week, for example, let's try and convert how much am I paying per day? And perhaps when you do that, you realize that's a lot of money that, it doesn't make sense. And you may say you're borrowing little, but in the long run, it becomes a lot of money. Let's try and navigate loans wisely and avoid bad loans. Then, of course, as I alluded to earlier, let's try and live within our means. How do we ensure that? Let's always ensure that what we are living on is commensurate to our income. Let's not go living beyond our means and we find that we have to borrow money to finance our lifestyles. This takes us into a situation where we are living a life that we cannot sustain, and in the long run, it becomes very expensive for our pockets. And most times we tend to think that wealth is what we are spending, but no, wealth is actually what we invest and what grows. Because as I've put there, wealth is not loud. It doesn't go announcing when we enter into a room. You'll be surprised that people who are very wealthy, you may not even pick them in a room. It whispers, that's what they say. So let's try as much as possible to manage our finances. Let's save and invest, no matter how little. Let's start with little, and that consistency over time grows to become something that we can be proud of. Then, of course, the next item is we plan for major life milestones. What are we talking about? Things that don't happen every day. We know we have children. We know after 5 years they will go to school. Can we start planning for their education? Let's put aside money today, even if the child is 1 year, because 5 years from now, they will go to school. Then it will get the pressure off us when they go to school. Structure that financial management in a way that it doesn't stress you. We know, for example, we have, say, a wedding coming up. Can we start planning early enough for this wedding and put aside money so that you don't then start running around looking for the money and getting stressed around it? You know, retirement is coming up. It's tied to age. After age 50, 60, we will retire. What are we doing about it? No one told us, but here we are telling you mentees that if we start early, if we start by the age 20, put aside something for your retirement. By the time you get to retirement age, or by the time as your age advances, the pressure of retirement is taken off you, because that little money you are putting aside, somebody has invested it for you. It has been growing consistently. And over time, the earlier you start, the more the growth trajectory of your income. So let's try and plan for these major life milestones early enough. It takes the stress off us, and it gives us an opportunity to grow our portfolio in a way that it will manage whatever it is that we are planning for. Then, of course, even as we do these things, there are things that we can't really plan for. They come. They are called emergencies. Perhaps people will get sick. Something will happen in the home that you will need to maintain. You know, emergency funds, things that we can't really say will happen tomorrow, but they do happen. Let's build an emergency fund. The ideal situation is usually to have at least up to 6 months of your total living expenses put aside, so that when that emergency comes, 1 or 2 or 3, they may not come together, but you know that you have something somewhere put aside to take care of this emergency. Let's try as much as possible, start small and consistently build this emergency fund until we are at a place where we are comfortable and you're not always thinking, if I lose my job today, if I lose my source of income today, how will I deal with tomorrow? This emergency fund comes to step in and take care of this. And of course, there's also a sinking fund, ideal for certain matters that we know about, as we were talking about the previous point of major life milestones like school fees, like medical expenses. Say, for example, you'd like to go on holiday, you have a wedding coming up. When you build a fund for this, it is called a sinking fund because it is for a specific purpose and you know it. You know that school fees, time to pay school fees is coming. You will tap into this fund and pay the fees. That's a sinking fund. So it is for a purpose. Then once the purpose has, you have met the purpose, then you move on to the next purpose. So if we can build emergency funds, if we can build a sinking fund, it helps us manage our finances better. It takes the stress off us when we are required to pay for this requirement. And then on a continuous basis, let's build our personal finance education. We have so many platforms this day, and with the internet, we can go in and do some research, we read. Let's grow ourselves so that we are able to take ourselves to the next level, and we don't have to wait for the next person to come and tell us how to manage our finances. So that's the point on effective financial management. And having looked at that and considered each of the items highlighted there, we can then think about setting financial goals. Setting financial goals, and more so focusing on investments. Ideally, when we are at a comfortable place financially in terms of meeting our expenses, we need to think about getting to a place where we will not just rely on, every month's income to survive, living paycheck to paycheck. Let's build our finances to grow in a way that we are investing. And we say we are investing where you're putting that money away where it earns a return for you. There's a difference between investing and saving. When we're putting money in the bank, that is saving. It's a good place to start, but we need to also now move away from not just saving, but investing, where we take a bit of the money as well, put it away where you will be paid a return that then grows that money for you. Because once you have earned the return, there's what is called the element of compounding. The interest is then commingled together with your principal, and you're able to earn a higher interest because you're earning not just interest on your principal, but interest also on the interest that you have earned. The compounding growth, that's what we refer to as compounding growth. So who then is supposed to be investing? Everyone. You and I should try as much as possible to invest. Let's not say that I will wait for my income to grow to this level to be able to invest. If we start small, that consistent journey builds you and gives you resilience to be able to continue growing yourself and have the confidence to know that I can actually do this. And especially when you start citing, say, your statements, and you're able to see, I invested 5,000, I have gotten a return of, even if it is 100 shillings, to start with, or I have gotten a return of 500, then over time that grows. You have put in 10,000, you've gotten a return of 2,000. It is 2,000 you didn't have. So let's work on trying to grow our money habits in a way that we are comfortable denying ourselves a little today to be able to grow ourselves for the future. We've talked about building an emergency fund. It's part of the goals that we ought to have, so that we are able to pay off any emergencies that come and find us in situations where we are not ready. And then, of course, I've alluded to the fact of compound growth. Compound growth is actually considered, like the eighth wonder of the world, because when we are consistently investing and getting returns of those investments, and looking at how those returns then are being pumped back into principal and earning us a higher return, then that compounding factor in our monies can get us to levels we actually never thought we would get. Okay, so assume, for example, you put in 1 million and somebody is paying you 10% on that. That is material money, when you put back, and then the next time they're computing interest on that money, you will not just be earning, a return on just that 1 million. You have somebody is paying 10% on that 1 million. You will be earning with the 1 million plus the 1%. So that compounding growth gives you some returns that you never would have gotten if you just kept the money in the bank or at home or wherever else. So when we look at that compounding growth of income, then it should encourage us to invest where we can get a return. And that's where we look at the returns and the risk when we're making a decision on where to invest. We ought to remember that the higher the return, the higher the risk. And we need to ask ourselves, when an investment proposal is placed in our hands, when somebody tells you you will earn a return of 20%, and the market is paying returns of 10%, then we ask ourselves the questions of how are you able to pay 20% and the market is at 10%, for example. Let's do our homework, because at times you find underlying factors that perhaps the person selling to you the investment doesn't quite come clean about. So we ask ourselves, and you realize the higher the return, the higher the risk, meaning that when you put in your money in higher return investment vehicles, you're more likely to lose that money as well. Unlike when you put in investment vehicles where the return is aligned to the market. So we ask ourselves those questions before we make those investment decisions, and avoid as much as possible what we call in our market get rich quick schemes, because they are there, pyramid schemes. Let's avoid getting into those, because then we end up getting ourselves in situations where we don't get any return and we don't get our principal back. So look at the risk and the return when you're making that investment decision. Then consider, when I'm making this investment, do I need this money for liquidity? So that then you decide you will invest in platform X as opposed to Y, because I will need this liquidity, say, in 1 year, or I will need it in 6 months, or I will need it in 3 months. Don't go and lock your money in platforms which you cannot access when you need it. So consider the liquidity. Is it accessible? And will you be able to access it when you need it? So if, for example, you have built your emergency fund, don't go and buy a 10-year-old bond in the market, because you will not be able to access the funds when you need, when the emergency comes. As we said, the emergencies come and they don't knock, they just show up. Invest in, for example, a money market fund where liquidity is accessible and you can withdraw when you need it. Or, you know, if it's real emergency situations or a sinking fund, just put it in a bank savings account and withdraw it when you need it. So think about that when you're making the investment decision. And then, of course, don't put your eggs in one basket. Diversification. Let's diversify when we are doing when we are making these investment decisions. We invest in this platform, we invest in the other, so that we are able to minimize risk, as opposed to having all our eggs in one basket and then our risks are much higher. This is what we call cost averaging. When we're making the decision to invest, look at the costs and, you know, know when to make the decision. When the costs are going up, when the costs are going down, do you go in, do you go out in that investment? That is what is called cost averaging. Now, when we have considered all this, then we have various options for investing. And on the fourth point there, I've just listed a couple of investment options that we would consider. We have stocks, you know, we have government securities, we have collective investment schemes, or what is mainly called as unit trusts or money market funds, or, you know, or special funds. Then we have, of course, for retirement, we have registered retirement benefit schemes. We have registered home ownership schemes. We have SACCOs, and then cash value life insurance policies. We have annuities, mostly for retirement purposes. Then there's rental real estate and undeveloped land. Of course, we all do know about that. We love buying land in our country. So those are the options. And of course, there could be many more, but I thought to highlight a few that we would consider as you're thinking about, you know, investing and what would work for you. Then once we have made the investment decision and we have decided and we have, you know, we have looked at our portfolio, we are managing our investments right and our finances right, we think about risk management. And risk management, we cannot, you know, isolate ourselves from risk once we have decided to invest. This, we have to think about how we manage it, because we cannot avoid, we are not investing or putting our money in a vacuum. We are living in the market and risks do happen. So how can we avoid losing the money that we have? How can we avoid, how can we reduce the losses that we make, or, you know, maximize the returns? So we consider risk management to be the soldiers that will assist us in this journey. And this would be, for example, taking insurance, writing wills and trust. They actually guard us against any, vagaries that we might, vagaries of fate that we might encounter as we journey life. So let's try and look at this. And I know we don't often talk about writing wills, especially in our kind of upbringing or trust. But there'll be no point of doing all the work, and then once we are gone, our beneficiaries are not well guided on how they will proceed. So let's work on that. If we have to take medical insurance and other insurances, let's do that. It helps in this. Okay, and when we are making decisions, we should always, financial decisions, we should always ask, is this something that we can afford to lose when we are deciding on where to invest? Can we afford to lose this? If we're not sure about something, don't take a risk of something that you can't afford to lose. And it goes the same way, for example, say you're lending money. It is a risk you're taking. Is it money that you're willing to lose? Give only what you're willing to lose. And if they settle the debt, then, it is an added advantage. But let's ask ourselves those questions that, we often don't ask ourselves. We only take the risk of what we are willing to lose. And don't risk a lot for a little. As I had mentioned earlier, ask yourself, if the return is this high and the market rate is this high, why should I take that high risk? And perhaps the person even selling the option is not explaining to you why you need to take that risk. So don't risk so much because then you will, and you're losing. So don't risk a lot for little. Try as much as possible to avoid that, and consider all the odds when you're making the decision on investment. And then you will be managing, the risk that comes with any investment as you should. And then once you have done that, of course, we talked about earlier, looking at these decisions and constantly reviewing them, what you have implemented. If we can look at the next slide. Because no matter how brilliant your personal financial plan is, it will do you no good unless you are putting it into practice and you're constantly coming back to it to check what is working and what is not working. So keep reviewing your budget, keep reviewing your plan, your investment plan, keep reviewing your money habits and see what is working. If something is working, keep doing it. If something is not working, then you need to drop it. And of course, when you have a major life change circumstance, you perhaps need to change your plan. Say today you're not married and tomorrow you get married. Your plan today will not work tomorrow because now you're not alone. You have another party in your plan. Today you have no children, tomorrow you have children. Something has happened that you will need to alter that plan. So review your financial plans as you go along, depending on the changes that come. And even when there are no clear changes, it is important to have a date with your money as often as you can. And monthly will be a good time, and especially if you have a regular income, sit down and have a date with your money when the income flows, because if you miss a week after that income has come in, you will find that it finds a way to get out just somehow. So have a date with your money, have a budget book, put it down in writing, make those goals that you need to make as often as you can and review them and constantly come back to them to just check that you're going in line with the plan that you intended. So having looked at those 6 pillars that we highlighted earlier, I just then thought about that of this, it is important to go a little bit more into budgeting because it will assist us. It's a tool that will assist us be able to just manage our financials right. And it is that tool that we need to walk around with. When you're having our money date, as I have mentioned, we have to keep referring to our budget, and those plans will be put in our budget. So I just put a summary of a few types of budgets that we can look at or think about when we are deciding how we budget. The next slide looks at those 5. How many types do we have? About 6 that I came up with, or that I was able to put together, types of budgets that you can use when you're trying to see how you manage your finances. The first one is where you pay yourself first. This is the first one, and I put it there because I think it is ideal. You know, when you get your finances, then you say, I will put aside X for paying myself. And paying yourself is not what these days people say, kupatia mwili pole. No, it is you take that, whatever you've allocated to paying yourself, and you put it in an income generating activity or in an investment where it will give you a return. Okay, and over time, as we have said, because of the compounding effect, you will see the benefit of that. So that's the first kind of budget, where you take out X, you say out of my whatever I earn, my 10% will be going to paying myself. I take out my 10%, I invest, and then with what is left, then I'm able to budget for other expenses and other needs. That's the first one, pay yourself first. The second one is what is called the zero-sum dollar budgeting or shilling budgeting, however you want to call it. And here you take whatever you get and allocate it equally to all the needs that you have. So you decide this much will be going to investment, this much will be going to paying my rent, this will be going to paying school fees, this and that. So you take everything and ensure that everything is allocated. You earn 100,000, out of that 100,000, nothing is left unallocated, because we find that when we don't allocate, then it will always have a use. And that money that is left unallocated most times ends up being misused. So this one is the budgeting that talks about you taking all those monies that you have and allocating everything to the last cent. The third one is envelope budget strategy. And this one, as it says, is just that. You allocate monies to various needs and put them in various envelopes. It helps with discipline. And you say, this is rent money. Once you have your money date when you're paid, rent money, put it in envelope 1. This is for paying this expense, for shopping, put it in this envelope. So that when you need to do shopping, say for the month, and you have allocated, say 10,000 and it's in this envelope, and you keep removing one. When the 10,000 is over, or there's nothing in that envelope, then you know that you're not shopping anymore. That is the budget, the envelope budget strategy. It's as plain as that. Putting things in different budgets or in different envelopes or in accounts, and spending them based on the envelope until your allocation for that purpose has ended. Now, the other one is a 50-30-20 rule, where 50% mandatory is for bills and expenses, 30% is for saving and investments, debt repayment, then 20% you reward yourself for, is for entertainment, fun, or, or meeting community needs or whatever it is that we do on the side. So that's the fourth strategy. And then there's the other one, which is the 60% budgeting solution. And here is where this one is mostly used where expenses are high. So we limit our spending on expenses to 60% of what we are getting. And then 40% is allocated to everything else. And finally, we have what is called the bare bones budgeting strategy. This one is a necessity-only budget, and it is usually used in tough times where we are just living paycheck to paycheck. We totally have no luxuries at all, because whatever we have is so little, we can only afford to survive. So in this situation, we use the bare bones budgeting strategy. And this may be at times due to high debt levels, which again, if we can try to minimize our debt levels, perhaps we can be able to use a different strategy, but this strategy is when it's really hard. So I thought to highlight these budgeting strategies, just to put them out there as we go into budgeting, because I do believe after this, perhaps we will want to have a date with our finances and see how best we can align them. Then we see which strategy works for us. And I hope that that will help us. And in conclusion, just to conclude there that financial independence is not a luxury. It's not a luxury at all. It's not, and we need to know that and just work on what we have to get ourselves to a place where we are comfortable, because financial independence is leverage. It gives us leverage. It puts us ahead. So let's try and work on where we are financially and see how we can put ourselves ahead so that we can have the leverage that we need in life. I hope that has been useful. This brings to the end my presentation, and of course I welcome any questions.
Fantastic, fantastic, amazing presentation, Felistas. There were a lot of nuggets of life, nuggets of things that we took with us. Very many insights, amazing stuff. Thank you so much. You are getting a lot of love, claps, flowers, love hearts, everything. We really thank you for downloading this unto us. I just want to turn to colleagues here to just see quickly what stood out for you. Like, what is one of the things you take away? What stood out for you, or even a question that you have? So that's one. And let's come on mic. And then, Felistas, I will be asking you a question around, but I want to first hear from colleagues in terms of just knowing that many of the young people, when you talk about income scenarios, we are talking about either they have zero income, or the income they have is the pocket money they have because of school and all that, or the income they have is entry level payment, salary, or even actually it's not zero income, it's negative because they're in debts. They have borrowed the uncle something, they have borrowed the mother something, they have borrowed, and that those scenarios are not just for young people who are in school. It is also for all of us. Like, maybe there are different scenarios in terms of income. And I like how you have ended with the budget, the different budgets. There's something for everyone. There's even the bare bones budget for if maybe my need right now is to manage my debts, is not even like investment. So that also is very helpful. But let me first turn to the audience to see what kind of questions, comments, reflections that we might have. And maybe, Holiday, if you are tracking the chat, are there any questions in chat?
Yes, we have 3 questions on the chat. 2 questions from one person. So his first question is, what are home ownership schemes? Will you share examples of that? And then his second question is, you take insurance policy, after 3 years it collapses. Do I lose money? So maybe we can address that, then I can go to the second question from the other person.
Okay, thank you. Home ownership schemes. This is where we save with the option to own a home after your savings have reached a certain level. They are mainly managed by HFCK. Housing Finance is the main bank. Right now it's a bank that has that opportunity, but we have perhaps others coming up, but that's the one that pops out, where you are saving with an intent to own a home. They have that platform, and when you do save for that, it's also saves you from taxes, because it's that money that you're saving with an intention to own a home is not taxed. So with the right employer tracking that and being able to deduct it before paying your taxes, you're able not only to save for a home, which may take time, but every month you're making this contribution, you don't pay taxes against your income that is going towards supporting you in owning a home in the future. I hope that answers that. The next one is on insurance. There goes my point on risk management. When we're thinking about where to invest, we have to do our homework. We cannot just put our money where we know the risks are quite high. And hence why I alluded to perhaps some investment options that almost come out like get rich quick schemes. We do have those. We have to do our homework so that wherever we are investing, the entity is not likely to collapse. It is a going concern. Let's look at the financials so that we are making an informed decision. And to your question, if you invest your monies in a platform that eventually collapses, it goes without saying that your investment will collapse with it. So that's what we are trying to mitigate when we talk about risk management. We do our homework before we make the decision to invest, so that we are investing in the right platforms.
Awesome, that's great. Thank you. Holiday, the next set of questions?
Yeah, so the next question is, do you know any sites where we can learn about financial independence and literacy as a beginner? And what circles, stocks would you recommend for someone who wants to start investing?
Sites where we can learning these days is quite available even on YouTube. We just search perhaps for financial management. I could gather a few people who I would recommend who speak and maybe share with Rosemary and you, Holiday, so that then you can share with the team. But there are people speaking about financial management on YouTube all the time, and you find a few nuggets here and there that we can take away even for beginners. So I will do some work and then I will share what I can come up with. But they're there on YouTube and other platforms in the internet. Now, the other one was on stocks and circles. And this is what I would say for beginners. I would not recommend stocks. Investment in stocks is high risk. So when you invest in stocks, you have to be willing to lose some and gain some. So for a beginner, stocks might not quite, in my view, be the best place to start. I would probably invest where I will first preserve my principal as I get a bit of return. When we invest in a stock, we are open to the volatility of the market, meaning that when the stock goes up, I go up with it. When it goes down, I go down with it. So I could even get to a point where the stock is even below where I bought it. It's therefore not a place where you want to start as a beginner, but you graduate with time into buying stocks as after you've already consolidated enough within platforms that preserve your principal. So a good place to start, if you ask me, would perhaps be money market funds, because these preserve your liquidity as you earn a bit of return. It may not be as high as you'd expect it because it's aligned to the market and it moves together with where the yields in the government securities are, but you are guaranteed that your principal is preserved. And then as you grow the funds and you have built your emergency fund or your sinking fund and you're in a good place, then you can diversify into stock markets. That's how I would respond to that. And with every situation, when you're making choices on stocks, the market varies differently and it really depends on what you're looking for. So it's not a question that can be answered on the spot. You'd need to really know what you're looking for so that then you make a decision on which stocks to buy when you're ready to buy after you have done the homework of each of the companies that you want to invest into. I hope I have responded to that.
Yeah, thank you. That's helpful, Felistas. Holiday, where are we now with the questions?
Yes, we have another question. As a young person just starting out, what is the one financial habit you wish you had started earlier? And how do you stay consistent with it even when money is tight?
Actually, you have mentioned it. Consistency. Consistency. The one money habit is consistency. Whatever little you have, when you look at it and decide you're going to, for example, put aside X, that consistency to remain on that boat, putting aside the 1,000 or the 100 or the whatever you decide that you will put aside, over time becomes a pot that you can leverage on. So when we make that decision to look at our finances and make decisions, let's stick to the goals that we make and have those money dates that we are discussing here, consistently reviewing what we have agreed on and seeing if we are going into the path that we intend to go. So the one money decision I should have done earlier was to start budgeting and be consistent in budgeting.
Yeah, and I think that one of the insights I take away from here is the have a date with your money. Maybe we do that in some form, but not in a consistent manner. So that's something that I'm finding perhaps is the best practice and a nugget to take from here, and to have that moment in order to ask yourself, are you traveling in the light? Are you moving towards the right direction when it comes to your money goals? So I think in terms of one financial habit, I think it's also the same for me, and I'm aligned with you, Felistas. Budgeting. And even as we reflect on that, I think it will be important we look at budgeting and the different scenarios we spoke about if the only income I have is maybe the pocket money I get. I'm wondering, even to hear from students here or university graduates, people who are in their first year of their employment, what is your experience around that, and what reflections do you have, colleagues? But I think we continue to look at the questions in the chat. If Holiday, you can call out the next couple of questions.
Yeah, we have about 2 more questions. So the first one is, what budgeting apps would you recommend in place of envelope budgeting?
I want to go very old school, and for me, the old school has worked. I have a budget book, a small notebook, the small ones in the supermarket these days. And every month when I have my money date, I will sit down with that notebook and I will write my budget, say for this month was the month of May. That for me, the old school way works best. I know the young people now want apps and everything digital, but for me, the notebook works best because I can even go back to the notebook I had, say, 5 or 10 years ago and see the journey that I have traveled. An alternative perhaps will be, if you want to keep it digital, is go Excel. Excel is a good, a way to track your expenses without making it complicated. Put everything on Excel and keep having a different sheet for every month. But what we are trying to do here is to enable the consistency. We also need to see the journey we're traveling, to be able to turn pages and see where we came from 10 months ago or 10 years ago or 5 years ago. So for me, I'll keep it old school and use the notebook or Excel.
Thanks for that, Felistas. I want to just check whether on the call we have anyone who has used like an app or another platform, e-platform for budgeting, for management. So Felistas' experience is around the old school, which works for her. Is there anyone who has an experience where an app is working for you? Because that, I think that comes to just show how diverse we are. Some people will use apps, electronic platforms, other people old school. Could you, okay, so Virginia wants to come in. Could you kindly unmute? Holiday?
Yeah, I'm not able to unmute you on my side, Virginia. Maybe you can try leaving, then joining again. There could be something wrong.
Oh, sorry. All right. Muleshe Were, as a beginner, you've been using some apps. Do you want to come on and just talk a bit about that?
What? Okay, thank you for this opportunity. My name is... Masilidia Muleshe. And as a beginner, I've been using Chums. Chums is a money market fund where they give you spaces, they give you a chance to save a certain amount of money for a certain amount of time. And it can either be locked, it can be opened for you to withdraw. And also for the withdrawal, it takes for about 48 hours. And you are able to check, you can save as a group, you can save as an individual. You can save with your partner. And in saving with groups, with your partner, you're able to give yourself. We currently have 4,000 in our savings account, and the interest is about, I think, 20%, if I'm not wrong. So it grows pole pole, and it has helped me to be disciplined with my money. And also for Etika is the same thing, but for Etika you save as an individual, and you can have different saving forums, like if you're saving for school fees, if you're saving for personal purposes, if you're saving for something that you want, you can be able to save differently in the same app. That's according to me.
All right, thank you so much. So there are platforms for saving, and thank you for sharing that. It's in the chat. I think we can take a time and explore at our own. When you have your money date next time, take time to explore which platforms might work for you. And I recognize that some are for saving, for investing, and even before we get there, we really need to first do the budgeting, so that we can allocate, how much, when I get onto Chums, how much am I saving? So the budgeting component is really important, because that's where it all starts. I want to also acknowledge Peter Oluoch. I see you and your many comments. Really appreciate the input and insights you are sharing. And I take note of one of the reflections you have, that even as we plan and do our homework, some of the information is hidden. You can't see it. You can't know that a company will collapse. You are just shocked that a corporate insurance collapses. May I give you like 1 minute to reflect on that, Peter, if you can come off mute?
Hi, how are you?
Very well, we can hear you.
Yeah, thank you for the opportunity. And I want to salute the presenter, very good points listed there. I've tried a number of them, and some worked, some I failed terribly. The one for the risk management she talked about is the one for insurance. So I took a insurance policy with corporate insurance. And the insurance policies, there are many. The insurance companies, there are many. There are about 50. Kina Jubilee Insurance, Britam, all these places, Old Mutual. So when the insurance people come to you, they sell you and they tell you very juicy stories. And of course, you get convinced and start saving and start protecting. It's protection basically. 2 years, 3 years, 5 years down the line, the company collapses and all your money is gone. And you can't tell whether this company was sound or whether the finances were sound or not, because some of them are even listed in the Nairobi Stock Exchange, for example. Then you lose all your money. So some of these things, it's a risk, and dealing with them can also be very, very challenging. Yeah, that's my bad experience. Thank you. If you have questions, I can answer.
Yeah, thank you so much for sharing that, because then it can connect with the point of saying that we are not, I think, falling for every marketing experience can be a mistake. So even we need to vet, and like Peter is saying, sometimes you may not necessarily know, but there's some due diligence. There's like talking, exploring, hearing stories like those of Peter, and really just really thinking before you commit. Perhaps some are inevitable, but I think a whole majority of perhaps the investment we make, you can do some due diligence. So we appreciate both sides of the section. So Virginia, you are now able to come on. So please take the floor.
Yeah. Thank you, Rosemary. Thank you so much, Felistas. Really nice to see you after many years. A fantastic session, a very practical, tips and nuggets that you have shared. I'm the one who asked about the envelope budgeting, because what I understood about that is that you actually have physical envelopes where you put money. So I wanted to know whether there are apps or digitally what you can use. You mentioned about using a notebook. I normally use Google Sheets. So Google Sheets is actually good if you're doing a family budget and everybody can have access to it. It's Excel, but Google Sheets. So back to my question about envelope budgeting. Is there any app that you can use virtually instead of those physical envelopes? Do you know?
Hi, Virginia. Nice to hear you, and thank you for the good feedback. I'm not aware of any digital platforms or digital apps that we can use, but where the budget is huge, say for each envelope, there's also the proposal to have different accounts for different options. Of course, it's not practical all the time, but this budget envelope option is mainly for, again, where we don't have too many envelopes to use. You know, maybe not in a family setting, maybe for beginners, the envelope works, or where you really need that discipline to just know that this money is in this envelope for this purpose. I've not come across a digital option for this.
Okay. All right. Thanks, Felistas.
You're welcome.
Awesome. So we have great engagement. Some of the key nuggets, things that really stood out for me include like financial independence is not a luxury, but rather a leverage. That means something that puts you ahead, something that can help you accelerate and make progress. I also like it very much, Felistas, when you said, and this really stood out for me, that that compound growth is the eighth wonder of the world. I've never heard that. And when you put it like that, it's really captured my attention. The eighth wonder of the world, compound growth. Could we talk a little more about compound growth?
Yeah.
Because I'm thinking as a takeaway from this conversation, even as we begin to wind up, it will be really important that as we go, if all I have is my pocket money, if all I have is the money that I get on my birthday, the 1,000 that friends come together, they give me like an envelope, how can I make sure that even with that 1,000 that I'm getting as pocket money, that I'm getting for my fare, that I'm getting for my lunch, the small money I get on birthday, the money I get when I talk to my uncle nicely and he gives me some data money,
Yeah.
How can I even use that to utilize the pay me first, or even you called it what? The one where you do the zero sum to say that, yes, the 1,000 I got on my birthday, how can I even take even a 10% of that and say, I'm not going to buy chips, I'm not going to get an Uber, I'm not going to buy data to go and browse Facebook for nothing, but actually I'm going to begin to think about this compound process, so that if I'm at the university right now, I can put away, even if it's just 100 shillings, and where do I put that? Because we're talking about not so much money. Maybe you can unpack that a bit for us.
Yeah, unlike our times, Rosemary, when we were, say, in campus, the time now we have, the financial market has really opened up, and we have so many money market, funds or, funds that manage your monies collectively, where I don't necessarily have to be the only one investing. They'll take your money, they'll take Virginia's money and the others and consolidate it together. Then they have a higher pool to invest from. So even with my allowance as a student, I can still be able to open a fund, and somebody alluded to that. One of the ladies alluded to that, where you put in little every month, and it is not for nothing. That fund is paying you. So, for example, say you're getting an allowance of, example, you're getting say 2,000 every month as your allowance, and you decide. I think there are funds where you can open with as little as 500 shillings. So as your starting point. So you decide, for example, every month you'll be putting away 500 shillings from that 2,000 that you're getting. In a year, you have put aside 6,000. You're putting 500 shillings every month. You have put aside at the end of the year 6,000. And if this money, your 6,000, is earning 10%, you will earn 600 out of it. Okay? And now your return will not just be on 6,000, it will be on 6,600. And it keeps growing as the interest is compounded, because most of them do compound monthly. As the interest is compounded monthly, your return keeps growing. And we are looking at a small sum. So you can only imagine if it's a little much more, how much more you can make in return that you didn't have. So if we can make that decision, for example, to look at these funds that are giving you an opportunity to invest as little as 500, and then make the personal decision to be consistent, to put away that 500 every month, or even a little more, depending on whatever else you get, then see how much more you will be getting, right? So it is just a matter of the discipline coming in and us deciding that every month you will put away that little money. I think back to our days in university when we got money from help or even from home, and how we used that money. And at times I wonder if we had the opportunity to put away a little, by the time we left after 4 years, how much would we have had to start life, you know? So that discipline and consistency for me counts for much. And to the point of even putting some emergency fund away. This comes in handy when it is time for you to draw on something. You will not just have your 1,000, you will have a 500 on top that you earned from just that discipline. So I don't know if that addresses your query, but I would say right now, the opportunities are much more than they were. You can invest as little as 500 shillings. I've had somebody talking about 250, but I know 500 shillings and 1,000. So there are funds where you can put in consistently that 1,000, and over time, it will give you that effect of compound growth. And I learned with discipline, when you learn to put away that 500, it will not be difficult to put away more because you have cultivated the discipline. When the more comes, it makes it easier for you to put away.
Excellent, excellent, excellent. I'm liking it because on this call and on Nuggets of Life, we have people from different walks of life. We have people who are just starting. So maybe what they can do consistently is 250. And I want someone on the chat, whether it's Muleshe, Mercy, or Naomi, I saw you were discussing about some of the platforms. What is the minimum you can put in your experience on Etika or the other platforms? Because we have people who can only put 500 or 250. But what we are learning from Felistas is that it's the discipline and the consistency. You can be a mamamboga, but you are consistently putting that 500. You are managing 500 and you are being very consistent. And so that's the power of the compounding is what we are now wanting to leverage. You can, maybe you're here, maybe you can, you now have a job, you've graduated, you have a job, you can put 5,000. So wherever you are in life, whether you are at the university, whether you are in college, whether you are at a kibanda selling cabbages, whether you are entry-level job, whether you are actually someone who is trying to manage debts, and you're trying to manage debt, and you work with what we were told about, I'm trying to remember the terminologies, zero sum, whereby you're managing debts and you're allocating something towards the debt, but you're also saying, let me take advantage of the compounding element and also put 100 shillings towards the growth and the investments, so that even as you continue to pursue your debts and to finish that, there's also something that is growing somewhere. So I like the concept of it can work for anyone. What we really need to do is to make sure we do our budget, have a budget. If you don't have a budget, make a date with your budget. Do the allocation, and when it comes to investing, the most powerful thing is let money work for you, let money grow for you, regardless of where you are in life and what your income level is, and take advantage of that compounding component. Now, I want to look into chat. I think colleagues are sharing different experiences. And maybe Mercy, you can just go through what are the different things. I mean, not Mercy, Holiday. What are you finding in terms of examples that colleagues are sharing?
Yeah, so what they're sharing is you can actually get to invest as low as 100 bob. So Pamela has mentioned 100 bob. Mercy has also mentioned 100 bob. And then Joseph has mentioned that for ZD Money Market Fund by Safaricom, you can also invest as low as 100 bob.
All right, thank you so much for that. So why are we not saving? Why are we not allocating? If it's up to even 100 bob, you can say you don't have a job. That's why you are not investing. Because for sure, at a company pocket money, you can put in 100 bob somewhere and take advantage of the compounding. And even maybe before you graduate, you now have something that you can use to buy the stock or to put in, to do all those things that we were talking about. So really ensuring that we are making our current financial situation work for us. Are there any additional questions, reflections before we give Felistas the final word in terms of what she's hearing from this discussion, and just the words that she will leave us with? But I just want to see if there are any comments, any thoughts, any reflections.
Good morning.
Pamela, good morning.
Okay, so one of my financial goals for last year and through this mentorship was better financial management and literacy and all that. And so I embarked on a journey to learn. And I had someone asking where you can learn. As our facilitator said, YouTube is a great place. Though, of course, you have to be careful who you are listening to. We have certified coaches. I listened to one, Susan Wanjiru. I think she makes weekly content videos, and she's a certified coach who has taught me so much on fixed income, how do we deal with black tax, how do we plan for our retirement, and I'm so happy, Madam Rosemary, that we have this session, and especially when we have so many young people who are just starting in life. Because one thing I learned is that for me, like right now, I'm 35 years. And if I need to plan for my retirement, then I have to really save quite a huge chunk of money. I don't know monthly or how I will do it because I'm starting late. But even as we save that 100 bob, we can look at when do I want to retire? Retirement age in Kenya is 50 years. If you consider the amount of money you need, ask yourself, how do I make that from between the years I have now and 50 years? How much money do I need to save? And then you realize that 100 bob is a lot. It goes quite a mile into helping you achieve that goal. When last year, but when I encountered I was told a story by one of my relatives who had just finished uni, and I think he had stayed out of the university for like 2 years. He was already working. He works with the ICA, but this guy had started sacrificing his lunch while he was, I think, in the second year in the university. He told me he would save 100 bob every day. Each day that was meant for lunch, he would sacrifice it. And by the time we were talking, I think around 2 years, he was telling me his money had grown to around 2M. Just 100 bob, because of the eighth wonder of compounding. So we sometimes like, for me, I feel I'm not where I want to be because I didn't get this information when I was younger. I wish I got it when I was younger, but we still, I'm still able to achieve something with the information I have now. And for all of us, you know, it all goes back to budgeting, so that you're able to avoid impulse buying and, you know, wasting money unnecessarily. It's better to have that money saved somewhere and you can't access it. Because when you have 20K lying in your M-Pesa, you have 500 bob lying in your M-Pesa, and your friend doesn't have supper in the university, and they're like, can you buy me? I don't have food. Please help me with 200 bob. You will send because you are a kind person, and this is another person who is sleeping hungry. But when you can't access that money, it's gone. And remember, when you can't access that money, it's already there, like it's for the future. So when we end up being too over generous and giving out money because we feel we can easily access it, we are robbing ourselves of our future. And so I have learned a lot this year. You can also follow Susan Wanjiru. I think there are two Susan Wanjiru, so I will share in our WhatsApp group the right one. And then, yeah, so let's please start saving. For me, I stayed for a long time, a very long time without work. So you can imagine, I think we need another session to learn about debt. How do we manage debt? For instance, you have stayed for long without a job, you have accumulated debts here and there. How do you do all that? And yeah, so I'm happy that although I've joined late, I've learned something like saving for housing. I didn't know that. And thank you, and I hope we save our way to the future. Thank you.
All right, that's really great, and I'm already hearing like what a follow-up conversation from today can look like and what topics you might be interested in. So we are taking note of that. Thank you so much, Pamela, for sharing even your personal story, your personal journey, struggle, but also your commitment to learning and to growth. Thank you so much. Joseph, please.
Thank you, Rosemary. And thank you, Felistas, for sharing this, which is very critical and very helpful to both young and old. I just had two comments. One is basically to say that while the older or those who've been working for a while have more income, which they can be able to budget and invest, they also end up having a lot of, huge obligations or responsibilities. And the reason why this session was good for the younger is that while they may not have a lot of income, at least their obligations are also not as huge. And I think what I take home from this session is that building good habits in saving and investing is very critical. As little as you may have, put aside something. The 50-30-20 rule was fantastic. And then when you invest something, you're able to have and create a fund for tomorrow, then you're able to, practice good habits. These habits are very critical as you go to earn more and have more responsibilities. And whatever you practice when you're young is what you bring into your older age. And therefore, it is very important. The other thing I wanted to comment on is, I think it was it Peter who mentioned about the insurance companies and the risk, the risk they're in. And just wanted to mention from my experience, I worked with an insurance company what has been said is true. Some of them are not very stable, but I think the critical thing is having to do the due diligence to know which are the better and stronger insurance companies which have good foundation. Before I joined insurance, I used to really have a very negative attitude on what they portrayed or what I thought was their way of practice, that they just sign you up and then they don't pay you whatever they promised to pay. But when I joined them, I was very amazed to realize that there are people who had, taken up insurance products, paid for a long period of time, and whatever they had been promised, for example, bonuses after every 5 years, were actually paid. Some of these clients never knew that their bonuses were paid. They just signed up, gave their contacts, probably when some of them are teachers. Maybe you're in school A, you move to school B or C, but you do not update the insurance company with your new contacts. So eventually, as you continue paying your policy, 5 years are over, your bonus is out, and it is sent to the branch where you signed up, and it just stays there without your knowledge. When I joined, I realized there are checks which had stayed there for over 1 year, 2 years. You've tried to call up this client, but they don't get to respond, or you're not able to trace them. So there's a good and a bad side of it. So the key thing is looking at doing your due diligence to know which are good, which have been there for long, which have strong foundations, and then now reading in between the prints. So that you can be able to know what your policy is actually talking about, and then a follow-up with the insurance company apart from just being for your premiums. That is my comment for today. Thank you very much.
Asante, thank you so much, Joseph, even for bringing your personal experience as a professional who has worked in the insurance industry for a long time. That is very well received and appreciated. We really appreciate. So just given that time is up, we want to then just invite Felistas, and then maybe Holiday can make a few announcements about how you can continue to engage with Nuggets of Life, the different platforms that we have, and then also the frequency of this call as we look forward to welcoming you to our next one. It is likely that we might do a part 2 of this one, just given the interest and the kind of questions and discussions that are happening. But you will watch out from the social media, the different platforms that Holiday will speak about for what will be coming up next. Over to you, Felistas.
Thank you, Rosemary. I thank you for the comments, Joseph and Pamela. Quite insightful. And Pamela, I echo your recommendation of Susan. I think she's a great coach, and it's important to look out for the certified coaches, even as we look for the information and try to sieve out, the bad weed. But as I promised, I will try to do my homework as well and share what I can, but she was in my list of what I was to share. Now, just to my closing comments, I just want to appreciate having been given this opportunity to share a bit of what information that we have, and hopefully it has been insightful. And I just want to reiterate as we close that when we are young, as Joseph said, we may not have the money, but we do have the time, and time is a great resource. So if we capitalize on this time and start early with the little that we have, over time, when we get to later years, then we find that management of time that we had starting from our 20s has paid off, even if what we were putting away was not as much as we would now when we are a little older. So let's take advantage of the time that we have as young people. Let's try and be consistent and disciplined and just challenge ourselves beyond our comfort zone. As Pamela alluded to, even just making that sacrifice of missing your lunch or something else, let's make those sacrifices because they will count for later. The time that you will get that statement and actually see the impact of perhaps the compounding interest will give you so much joy you will not believe. So my point here is, because we have time as young people, Let's try and take advantage of the time. Let's be consistent, and we will benefit from that consistency, and our time will for sure pay off. I want to close at that.
Thank you. Thank you so much. We may not have the money or the money we need, but we have the time to make the money work. The little we have work. Thank you so much, Felistas. We honor you. We appreciate you. May God bless you, replenish you, expand you, take you to higher levels and higher dimensions in your life, in your career. And we look forward to welcoming you again onto this platform, and to also joining us as a mentor on Nuggets of Life platform. We thank you, and we honor you. So, Hali, over to you for any announcements. Thank you.
Thanks, Rosemary.
Hello, if I may ask question, how do we join a WhatsApp group?
Yes, that's what Halide is about to talk about. Halide, please. Thank you. That was Nunush.
Yes, thank you.
Welcome, welcome. So Halide, kindly. All right, I can't see Holiday, but if you look at in the chat, a number of social media platforms have been shared in terms of how you can connect with Nuggets of Life. You can follow us on Insta, it's there. You can follow us on Facebook. You can follow us on LinkedIn. There is a website. And so the WhatsApp channel is a channel where we share information, is right there, and that's the WhatsApp. If you click there, you can join the WhatsApp channel where we share information about when the next call is coming up, the summary maybe from this discussion, the key takeaway, but also you can feel free to directly contact the Nuggets of Life phone number. If Holiday or Rachel, you can just drop in how someone can reach out to the office in terms of a phone call or an email. Please just put it there in chat. Are you there, Holiday or Rachel?
Yes, I'm here. Let me get the details and then I'll just share shortly.
Yes, because I think we cannot, maybe Holiday cannot hear me. So this is it. Feel free to engage. I'm seeing that we are likely to have a follow-up conversation around financing, around investment, around how can we just continue to grow towards financial freedom based on where we are. And so it's really is important that we continue to draw from everyone. I see there are many people on the call who have different expertise, who have gone through this, made mistakes, and can share with us nuggets of what not to do. I want to thank participants who have shared the links. We see there are some YouTube links that have been shared, whether it's the one from Susan, whether it's the one that Holiday has shared, the different money platforms shared by Joseph, Pamela, Muleshe. I see Naomi Wangoi has shared something, Etika Mansa, and so on and so forth. So I think if we can all bring everything we know together, we can cross-fertilize and help each other towards growth. So for colleagues who are looking to reach out to Nuggets of Life, a phone number has also been shared. You can text, you can call for inquiry, but also most importantly, join the WhatsApp channel for continued engagement. I think that is it, unless there is anyone who has, from the office, who have an additional announcement from the Nuggets of Life team. If not, we want, yeah, Holiday?
Sorry. I got offline a bit. Sorry about that. I don't know if you've mentioned that we do have the next virtual forum in July. So you guys can just look out for that. Look out for the announcement on the social media pages because we usually put it there. And feel free to please join the WhatsApp channel so that you can get constant updates on the same. I think that's the only thing I have to add. Thank you.
Yeah, I had forgotten that one to say that this session happens every 2 months on a Saturday morning from 9 a.m. to 10:30. It's 1.5 hours long. It can be longer, but we are also very respectful of the speakers who come. They have other things to do. And all of us, I know some of you actually were taking this call either on your way to work, or some of you are on break from work, or you're multitasking. So we appreciate that. And once you engage, also feel free to suggest a topic that you think is going to be useful. We also do this virtual experience alongside a one-on-one mentorship. Every year we have a cohort of about 6, 7, 10, 12 young people who are engaging one-on-one with their mentors. And so it's also tailored to make sure that what we are hearing from the one-on-one, in terms of the needs, in terms of the goals the mentees have set, we can also channel that through to a broader audience. So we thank you very much. And Holiday has revised the number. Please note the number that Holiday has shared there. So Holiday, is this the correct number, the 0141?
Exactly. I just realized I put 0114 on the previous one. It's 0141 322 932. Available also on WhatsApp.
On that number, if you want to directly connect to the office to ask a question or to contribute a topic that you'd like shared. So without further ado, thank you so much to all the participants. We see you, we honor you, we acknowledge you. And let us remember that wealth is silent. It doesn't make a lot of noise. Let's work towards that. And it's also a biblical principle that God desires that we be financially stable and that we create wealth for generations, not just for us. We thank you very much. Have a wonderful day, Father. Over.
Thank you. Have a good day, everyone.
A good day as well.
Enjoy your weekend.